Welcome to Thoughts on the Market. I'm Mike Wilson, Morgan Stanley CIO and Chief U.S. Equity Strategist. Today on the podcast, I'll discuss recent developments on tariffs and interest rates and how it affects our 12-month view for U.S. equities. It's Friday, May 23rd at 9 a.m. in New York. So let's get after it. The reduction in the headline tariff rate on China from 145% to 30% extended the rally in stocks last week and should help to support both corporate and consumer confidence. More importantly, the 90-day détente came at a critical juncture in my view, as a few more weeks of what was essentially a trade embargo would have likely led to a recession. Equity market volatility also subsided considerably amid the decline in trade policy uncertainty. In fact, both measures peaked well before the deal with China came together and are now back below where they were pre-Liberation Day. To me, this means trade headwinds have likely peaked in rate of change terms and are unlikely to return to such levels again. This would fit with the capitulatory price action we saw in early April, with the average stock in the S&P 500 experiencing a 30% drawdown. In short, while the lagging hard data is likely to come in softer over the next coming months, the equity market already priced it in April. In the event of a recession that still arrives, we think the April lows will still hold, assuming it's a mild one, with manageable risk to credit and funding markets. As further support for stocks, earnings revision breadth also appears to have bottomed. This indicator is leading properties in terms of the direction of earnings forecasts and is an important gauge of corporate confidence in our view. The combination of upside momentum and revision breadth and last week's deal with China has placed the S&P 500 firmly back in our original pre-liberation first half range of 5,500 to 6,100. Having said that, we think continued upward progress in earnings revision breadth into positive territory will be necessary to break through 6,100 in the near term, given the stickiness in 10-year Treasury yields. Amidst these developments, we released our Midyear outlook earlier this week and updated our base, bear, and bull case targets for the S&P 500. In short, we effectively pushed out the timing of our original 6,500 price target for the end of the year to 12 months from today. This is mainly due to a less dovish Fed and therefore higher 10-year Treasury yields than our economists and rate strategists expected at the end of last year. We also trimmed our EPS forecast modestly to adjust for higher than expected tariff rates, at least for now. Looking ahead, we are more bullish today than we were at the end of last year, given the growth negative policy announcements are now behind us and the Fed's next move is likely to be multiple cuts. In short, the rate of change on earnings revision breadth, interest rates, and policy changes from the administration are all now pointing in a positive direction, the opposite of 6 months ago and why I was not bullish on the first half of this year. The near-term risk for U.S. equities remains very overbought conditions and interest rates. With the Fed on hold due to lingering inflation concerns and Moody's downgrade of U.S. Treasury debt last Friday, 10-year Treasury yields are back above 4.5%. The level where the correlation between equities and rates tends to move back into negative territory. Ultimately, we think the Treasury and Fed have the tools that they can and will use to manage this risk. However, in the short term, this is a potential catalyst for the S&P 500 to take a break and even lead to a 5% correction. We would look to add equity risk into such a correction should it materialize, given our bullish 6 to 12-month view. Thanks for tuning in. I hope you found it informative and useful. Let us know what you think by leaving us a review. And if you find Thoughts on the Market worthwhile, tell a friend or colleague to try it out.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.